Welcome to Philly Fortune Talks with your host, Jake Penny, where the city's brightest minds share the secrets behind their success. Are you ready to be inspired?
In this episode, we're excited to welcome Kimberly Klayman, a seasoned legal professional specializing in representing emerging companies and investors. With over 11 years of experience, Kimberly has worked closely with venture capital, private equity firms, and family offices to help high-growth companies thrive. From pre-formation to mergers and acquisition, Kimberly offers expert guidance through every stage of the corporate life cycle. Tune in to hear her insights on business strategy, leadership, and innovation in a fast-paced world of venture capital and high-growth investments. Kimberly, it's a pleasure to have you on Philly Fortune Talks.
Great to be here, Jake. Thanks for having me.
Absolutely. So for the listeners that may not know you, if you don't mind giving them a brief intro about yourself, where you're coming from, in the journey to where you are today.
Sure. So my background and what I do on a day-to-day is I came up in Philly. I'm a Philly girl, so this is where I've lived prior to being a lawyer. And then I decided to plot down here, get my degree here. So I went to law school at UPenn and then started working for a national law firm, Ballard Spahr, where I've been working with emerging companies, venture capital funds, primarily in the beginning, really just working with founders and helping founders organize these new ventures and supporting their ideas, helping them go from financing to financing, helping them think through customer acquisition, specifically on the legal side, how to make that sticky through contract. Those are things that, at the very nascent parts of my career when I was working with younger startups primarily, that was sort of my day to day. And it's still very much my day to day. But now I would say I think of myself a little bit more of a mergers and acquisitions lawyer who's really leans forward into the emerging growth part of the life cycle of that company. So working with founders all the way from inception, all the way through several financings and hopefully helping them land that really big exit where they cash out. And that's
Yeah,
the real fun part of the job is watching people, reap the benefits of their work.
absolutely. Yeah, you have extensive experience guiding companies through like the pre-formation stage to mergers and acquisitions. What are some of the key challenges for startups that they face during this life cycle, and how do you help them navigate those?
So to me, the biggest challenge that founders face, especially ones that have great ideas that are, poised for success, is fatigue. It's a really hard thing to build a successful company. It requires not only having a great idea, but having the fortitude to push, work long hours, oftentimes wear uncomfortable, be in uncomfortable positions where you're wearing hats that you didn't expect to wear. Sometimes it means admitting failure at moments when you want to be constantly pushing a success story. So I think, all of those things can lead to, fatigue and burnout. And we talk a lot about, at least at our law firm, we work in a team here with our founders, and we talk a lot about founder burnout because we see it so often. And, it's often really a shame to see a great company not succeed simply because the person just didn't have I would say the support system. It's not something internal or problematic with the individual, but they don't necessarily have the support system around them to succeed. So from our perspective, a lot of what we're doing is helping those people overcome, we're helping founders overcome the things that really slow them down, that cause that fatigue, especially when it comes to if you're a brand new founder and you don't know the startup lingo. There's a lot of fatigue around, people throwing jargon at you that you've never heard before and feeling like you're not totally in the fray and working your butt off to try to get up to speed so that you can at least be having the same conversations with the people around you. So we work a lot on educating our founders to make sure that they don't have that experience of, not knowing what's going on around them and being confused for a while. We also try to introduce people a lot to peers so that they can have the opportunity to just feel in the mix, ask their, stupid questions to someone they feel connected to and comfortable with, but also to make them feel supported. I mean, that's the network that ends up helping people overcome that fatigue.
Yeah, absolutely. And when it comes to like startups and like venture capital, what advice would you give startups looking to like secure that venture capital financing, and how can they best position themselves to attract those investors?
So this is something I've thought about a lot, and I actually think at the end of the day, the biggest piece of advice I can give to someone is being prepared and also looking like you prepared. In other words, not making it seem too effortless, and also not making it seem like you don't care for some reason, like you're nonchalant, pays dividends. People want you to put time and effort into impressing them. And they also want to see that you are a hard worker that will roll up their sleeves and put the work in to earn not just the dollars that they're putting into the company, but their time and effort and resources that they're going to throw your way in conjunction with their investment. So I think there's been a bit of a move towards being casual, and it's not just casual in appearance but casual in how we conduct ourselves, and professionalism and the idea of being professional in your demeanor and in your interaction. I think to the extent that that's become less trendy, I think remembering the impact of that, especially on folks who might be from a different generation, is actually very impactful and often does help secure someone's trust and investment.
Yeah, every investor's avatar or their behaviors is different. So learning how to adapt to them, whether it's somebody like you said, more laid back or more strict and very proper and everything like that. So that's super important.
Yeah.
When it comes to like strategic acquisitions, you work with investors and companies to help with that. What do you think is like the most crucial factor for success in these transactions?
So, mergers and acquisitions is very different than securing VC financing. It's definitely a longer, more involved, and far more tiring process. Um, Understanding that, especially if you've never done a transaction like that, that's going to be, and you're going to repeatedly be thrown into like the uncomfortable position of doing something brand new, answering questions you've never had to answer before, preparing more than you expected to, spending more time on it than you expected to. I think calculating that into your overall perspective of whether the deal is worthwhile is useful. There's a thing called deal fatigue. I think I've used the word fatigue too much on this podcast so far, but there is that concept because they're really long and involved transactions. And it's the same thing as when you're just getting into raising capital. There's a lot of jargon, but this jargon is less known, it's less widespread because fewer people go through M&A transactions than go through financings.
Right.
More startups will go through a financing, even a small one, or friends and family seed round or an A round. There's just going to be more of those companies out there than there are companies that make it to that end game of an acquisition or a big transaction where they're doing all the documentation it takes to sell their company, a much bigger process, much more drawn out process than, selling a piece of the equity in their company.
Yeah, absolutely. So you counsel venture capital and also private equity funds. What are like the biggest trends that you're seeing right now in the investment landscape, particularly in like the high growth companies?
Sure. I think, in terms of, advising advising someone who's going to invest in a startup versus when we're advising buyers when it comes to M&A transactions, it's different advice because the person who's investing in a company recognizes there's a very high degree of risk associated with the investment. And a lot of that risk depends on their perspective of the potential uh, growth opportunity, basically, not just in sort of the documents we're using to secure that opportunity, but more in the founder itself and the idea or the service that's being sold by the venture. On the flip side, a buyer is usually trying to do something, obviously still has some risk associated with it, but the risk should have theoretically gotten down a good amount. And usually the buyer is looking to take over that company, meaning the buyer's vision for that product or service is really what's going to be driving the future success of the company. So because of that, we're really assessing two different things in those transactions. On the one hand, with an investor who's investing a piece, putting some passive cash into the company and hoping it grows, we're really looking to make sure that the individuals who are responsible for the company are incentivized to do what's right for the investor, meaning their interests are aligned. And we're making sure the documents say things that ensure that they're incentivized to grow the company in a responsible way, and that there is proper oversight, not too much, but enough to protect the investment, the investor's capital. On the buy side, we're doing a total full body exam of this company to make sure that there isn't any historical liabilities that could become the buyer's problem on the back end of the sale, right? Because these typically speaking, oftentimes the management does stay on for a period of time after the sale, but the buyer is really going to be in control of that company going forward. And so if there is something that is a problem pre-acquisition, it might remain a problem post-acquisition, except now it's the buyer's problem. So we're much more concerned in the acquisition structure in kind of ferreting out loose ends, skeletons in the closet. It's much more of a diligence exercise, whereas the investment is much more of a, hey, what's this relationship going to look like? Let's draft that agreement and make sure that we're in agreement as to what our interactions will look like going forward.
Yeah, the due diligence is super, super important, obviously for capital preservation of their principal, but also hey, moving forward, is this company actually going to grow? Are our LPs and GPs actually going to make returns on this? And is the company going to grow?
Right.
It's super important. With your experience with high growth companies, how do you advise clients to not only balance innovation, but also, have suitable growth?
I think innovation should theoretically inspire growth. Theoretically, if you're doing something innovative and you're doing it in a way that, is accessible to individuals and is being built in a way that's sustainable, that innovation should theoretically support the growth.
Right.
I think doing something different for the sake of doing something different, it might not be solving a problem. I think not doing your research about what's been successful in the industry in which you're playing is silly. As lawyers, we actually do see so much in terms of business models, especially repeated business models. And I think anybody who's in this space can tell you, there will be certain trends and we'll see things that are really hot for a while. And we see kind of what works and what doesn't work. So I think lawyers are actually in a great position to say, hey, we've seen this before. Here's how these other people may have failed. And you don't give all the specific details. There's obviously confidentiality, restrictions around what we can tell, founders about prior founders or prior clients. But, it is smart to vet, hey, do you guys work in this industry? If you're working with a lawyer and the lawyer says yes, oh, have you seen this model before in this industry specifically, or anything in a parallel industry that you could kind of relate to? Yes. Can you tell us a little bit about what worked or didn't work? What kind of trials did those people go through? We've definitely seen that. A really good example for us, or for me personally, is in the health tech sector, where we've worked a lot with companies that they're really not providing healthcare services. They're providing tech-enabled solutions within the healthcare industry. So the best way that I kind of come up in, that I've kind of started describing it is, they're not necessarily replacing doctors, but they might be replacing the doctor's clipboard in the office to help the doctor better keep track of notes, or better, organize their notes, or even filter their notes, or, rely upon the notes in a way that will then result in a better diagnosis, better treatment, etc. So we have a lot of companies that have gone through the process of explaining what they're doing in that health tech sector, which is really sitting in the healthcare world, but isn't a healthcare company. And I would say that something we learned a lot along the way is that, those companies really have to figure out early on whether they can really tackle being a direct to consumer company or a direct to provider company, and that those pathways while they might be really lucrative in the long run, take a really long time to build up, especially when you're replacing something that is deeply embedded in a institutionalized space like healthcare, where it's really dependent on networks and insurance and hospital networks and things that are just very bureaucratic. So going to the provider, individual consumer, you sometimes bump up against that red tape a lot. So we've seen that, and we've sort of been able to support clients that are doing a lot of different things, but all in that same space and dealing with the same end users. And that's been really helpful in terms of enabling them to think through their potential problems.
Yeah,
Business.
I feel like that can be pretty tough with that, with like the healthcare solution side, because majority of them are like whales, right? It's the big insurance companies, it's the big hospitals, and like going to B2C is kind of pretty hard. At least from what I think or I see, it's like who hold the chips is all the big corporations, and that can be tough sometimes.
Yeah, I mean, you have to think about who's your customer and not only like why are they buying your product, but how are they gonna, if your customer is ultimately a provider to somebody else, how are they gonna get paid and who's paying them and how is that person gonna view the use of the product? And that's been a fun way to sort of help folks think through. And honestly, even if we don't come up with the solution, being able to point out that issue often helps the founders, who are obviously far more creative than us as lawyers, come up with the right answer.
Yeah. So when it comes to like legal considerations for emerging companies, what are some key like legal aspects that emerging companies should be aware of as they scale, as they grow, particularly, in today's rapidly evolving markets?
The number one thing people get wrong in the startup sector is that they think that they can get free labor. People cannot work for free in America. We have wage and hour rules. We almost I mean, it's just a very high percentage of the time that founders will come to us after having started something and worked on it for a while. And they'll say, yeah, we did have somebody working on this, but we gave that person equity. But you're not allowed to replace wage and hour rules with equity. So oftentimes what we're talking to people about is, hey, let's think about the person that did these services for you. Do you think that person is an employer or contractor? Let's talk about specifically what they did, and they'll say, well, they're definitely a contractor. And we'll have to explain to the founders, well, you don't get to decide if they're a contractor. Actually, the law decides whether they're an employer or contractor. And the law decides whether, if they're an employee, you failed to pay them proper wage and hour and also failed to withhold, which is a tax issue. So it all gets like kind of piled up, piled up, piled up, and it sounds really scary. I mean, the reality is you have to think about this stuff on a spectrum of risk. And oftentimes, if what you're doing is working on a little startup on the side in your basement with a couple of buddies, is there a very high risk that the few hours that that person spent working on the venture, who was maybe technically an employee, during the few months that they worked on it, what's the likelihood that the IRS wants to audit that? What's the likelihood that you're going to get in trouble for, by your whatever state you're in for having, an employee that you didn't, properly pay? What's the likelihood that your friend will sue you? They're probably low, but later as the company grows, if something really takes off, those early missteps can be viewed, not generously by future investors. And certainly if you keep making those mistakes as you grow and as the company becomes more professionalized, then that risk of, will the IRS audit me? Will the state catch me for having an employee that I, not, paying into, whatever employer obligations I have from a state perspective, insurance, um, you know, withholding. If you don't do all those things for long enough, obviously the risk grows, and we've definitely seen people get, pinched
Right.
for, those missteps.
Yeah, definitely don't want that. That's for sure. Um,
Yeah, but that's the number one thing I would say. Our labor attorneys. I mean, I don't give that. When that stuff comes up, we have startup labor attorneys who are phenomenal colleagues of mine. They'll get on the phone and give what we call sort of the spiel on the proper behavior, risk mitigation pathways. If you've already set something up improperly, and how we would fix it. And we just go through all the, the ways that you sort of fix the issues that you've created.
Yeah, when it comes to like the high complexity of mergers and acquisitions, what are some of like the strategies that you do to like implement to ensure like a smooth and successful transaction during that process?
Oh, I really love this question. I think we do actually have great processes here because we work with founders who are often first-time users of professional service providers. We kind of have prided ourselves on developing processes that bring them along in complex transactions without letting it become too overwhelming. So we kind of have, I would say, three things that we use to keep things on track and moving forward, and that we think have helped us in terms of being good executioners of these transactions. One is that we have a checklist from the beginning describing, practically speaking, everything that's going to go into the transaction. Sometimes things are added to that over time, but we'll go through that checklist with the founder, the seller, the buyer up front, make sure that they're aware of the work that needs to happen so that we can, from the beginning, create a meaningful and realistic timeline. The second thing is we create what we call key issues lists for, and they're written out in layman's terms, oftentimes in a chart or a bullet point list, something very digestible, which describes more or less, it's a summary of the transaction document, which might be 80 pages long, but we'll distill it down to about 3 pages. So you can think of that as sort of the cliff notes to these documents. And depending on whether we're on the buy side or the sell side, we try to provide those cliff notes before we either draft, before we either send the document over, if we're the draftsman, or after we receive it, we'll do a summary and explain what it says and what we think needs to change about the document. But we'll do it in shorthand and in those cliff notes, not because we don't want the client to read the document, because we're aware that there's things that they'll read that they, when you're reading out of the context and without the training, might not be as comprehensible as,
Mhm.
and you might spend a lot of time working on, what does this paragraph mean? But really it's boilerplate, miscellaneous, prescribed by law type of stuff.
For sure.
Whereas, and then you miss sort of the meat of the document that actually might come to a head post closing when, something doesn't go right. So we do a really good job, I think, with the cliff noting, doing cliff notes basically for our clients to make sure that even if they're really not sophisticated in those transactions, and that doesn't mean they're not sophisticated people, it just means they're not legal experts, and they
Right.
most of the time are not, that we can make sure that they're brought along for the transaction. They're part of the conversation. They're informed about the documents that they're signing. And I actually think that having informed clients, both on the buy and sell side, when it comes to these transactions, leads to less deal risk. You're less likely to have an emotional blow up when everybody knows what's on the table and has the opportunity to digest and discuss it meaningfully if there's a business issue, or understand from their lawyers, hey, are they trying to pull a fast one on me? And usually the answer is no. It's just, routine negotiation. And let's talk about what's important to you up front so that we don't get to the finish line and feel like anybody shoving anything down your throat or something like that. So we're pretty good about that. Those were two things. I said checklist, I said cliff notes. The last thing I would say is we try pretty hard to not be alarmists. I think that a lot of people have a perspective. If you've worked with a lawyer that has been sort of a parade of horribles, who describes the parade of horribles associated with a particular provision, or your opposing party's perspective on something seems like totally crazy. We just try to avoid hyperbolic language. We think it creates more drama and less opportunity for everyone to think rationally about the pros and cons of the deal on the table. So those are our three kind of techniques, or at least I think that's what our team really, prescribes to in terms of making sure that the deal stays on track, moves at the right speed, everyone's aware of what's going on, and everyone comes to the table to sign at the end of the day with, a good feeling as opposed to a nervous feeling.
Yeah, absolutely. I love the like the Spark Notes, the Cliff Notes version. So I feel like that should be done across the board, whether you're looking at like PPM docs, subscription agreements, fund docs, Reg D docs, whatever. It's like a lot of people, and even like mergers and acquisitions, venture capital, all that stuff, a lot of people, they're packets, and it's like that, a lot of that stuff, people don't even know what they're reading. Like, yeah, there's a gist, but like a lot of that's legal jargon, and it's just confusing. It may, throw up, false red flags in their mind because they just don't understand. So that's awesome that you have like a Spark Notes version, Cliff Notes version to help them easily digest, so it's not, daunting on them.
Yeah, I think it's a critical part of the process, definitely. And it's good to know.
Absolutely. So a lot of people are like throw around family office, corporate venture groups, PE, venture capital funds. Um, what are like the differences and what are some of like the unique challenges or advantages that these things present?
Yeah. And I'll clarify that, I think the reason I get the benefit of working with across all different sectors of investors, 'cause you just described, like you said, four different areas, family
Hmm.
office, PE funds, or maybe I'll go in order, family office, maybe angel investors, then, venture capital funds, growth funds, and PE funds. The reason I get the benefit of, you know, more or less negotiating with all of those types of investors is because I really work on the founder side, which
Mm.
means I'm representing founders, and founders will have the opportunity to transact with any one of those investor types. Um, so the differences I would say is probably where you meet them in your life cycle. Family offices and angel investors tend to invest at the earlier stage. There are family offices, obviously, that are doing, I mean, family offices tend to invest in a lot of different asset classes. But when they're investing in startups, they tend to invest on the early stage. That's their sort of high risk portfolio of things that they're investing in. And, they'll differ in terms of check sizes, but they're also going to probably want a lot of things because they want to get a benefit for investing in something high risk. So they'll want discounts, they'll want lower valuations, they'll want rights, side letters, and things like that. Um, Growth funds and venture capital funds more so than growth funds. I'd say venture capital funds. They're probably the easiest to deal with in the startup sector. They know the space. This is their bread and butter. They're only investing basically early stage to kind of late stage startups, and usually all on the same types of terms and documents that evolve depending on where the market is. But those are folks who know this space, and a majority of their investments are going to be what we would call minority investments, meaning you're taking a less than controlling piece of the company in exchange for very kind of well known and agreed upon from a ecosystem standpoint set of control rights. Growth funds and PE funds, they tend to come in and the growth funds are obviously still trying to just grow these companies. They're not taking over entirely necessarily, meaning they're not buying 100% of the company, but they are going to want more control rights. They think that they have something to bring to the table in terms of management, efficiency, and then PE funds, they might buy the whole company 100%
Mhm.
and they're just taking over. It's a control position. So really, I think the spectrum you're seeing is from, we're coming in and putting money in and hope and betting on you founders. And as you move up the spectrum, the founder impact becomes a little bit less important. The product or service comes more into focus because the buyer, the investor is really going to come in and take over in terms of the personnel involved in commercialization. Um, you know, Startups again transact with all of these folks because at the beginning of their life cycle, they're talking to high net worth individuals, trying to get some friends and family money. Then the VCs come in, give them some institutional capital to grow. And then hopefully, if they're aiming for an M&A exit, they're talking to PE funds and strategic buyers that will buy out the founders and hopefully move this thing into kind of this massive growth opportunity. Um, or a strategic add-on to, if it's a strategic buyer that's already in that industry, hopefully growing that buyer's platform even bigger. And yeah, so I mean, from a founder, working with founders is awesome for me. I get to meet all of those folks. I get to kind of understand their rhythms uh, really well because I'm across from them so often, working with founders who've developed such cool ventures that have attracted these really amazing investors and institutional buyers.
Yeah. I love like, the whole journey, like you said, it's like, sophisticated, non-accredited, then accredited, and then you get to like family office venture, and it just like the tier keeps rising. But that's awesome. You help them through the whole journey of their, investor avatar as they grow.
Yeah, I mean, I think you don't have to meet all of those different characters in your journey. And there's definitely people out there who are like, I'll never work with a PE fund. I'll never want this type of money. I don't want money from that guy. Like you can definitely avoid any one of those characters in the journey. And the one thing we didn't talk about is just like purely organic growth. I mean, we have a couple clients right now. They're just gung ho. Like we're a startup, but our money's coming from revenue. And honestly, like all of those pathways are great and can lead to success, and can lead to a really innovative product. It comes down, there's not one recipe. I think there was a little bit of, I think there's always trends and sort of what's the right way to make the best
Mhm.
startup. But I don't think that there is one recipe. I think the best way and the way that we've sort of positioned our practice is to be very diversified in terms of who we think of as being the potential next success story.
Sure. So you've built a distinguished career in law and business strategy. What has been like some of the personal leadership's lessons you've learned over that journey that guided your approach to advising clients?
Sure. I feel like lessons learned means mistakes that I've had to like own up to and overcome. I guess, uh, I do think working collaboratively across the aisle from people is really important. I think that's something everyone not instinctively can do, but it intuitively knows that it's good to be collaborative. I think sometimes in the moment, especially when you're in an advocacy position, it's more difficult
Mm.
to always keep your eye on the prize, which is to move towards a compromise position. Oftentimes, not necessarily you won't get everything you want necessarily, but that collaborative spirit is something that I think, especially in a legal career, you grow into over time. So that's been something that I think I've definitely appreciated the import of as I've gotten more senior in my career.
Yeah.
In other words, not believing that, just because something should turn out a certain way, it necessarily will, and trying to figure out where the best possible outcome might be.
Yeah, for sure. Just, get back up when you fall down, and learn from your mistakes. And they're not failures unless if you learn from them, they're not failures, right? As long as you come out the other side smarter or know which way to navigate going forward, then, that's where all the greatness has come from. But as we wrap this up here, for listeners or in the audience that want to learn more about you, your services, everything that you do for your clients, where's the best place for them to go to and reach out?
So I'm the best way to reach me is by email. And then I usually email back really quickly, especially if it's to my work email, which is available online if you just look me up. But email's the best. In my work email, when I respond, my signature block or whatever has phone numbers and things like that. People are welcome to call me. Um, Leaving voice messages is not a good way to reach me, I've been told. I, I rarely am like really checking those. I think it's great now that they actually like type them out into that little text
Mhm.
message for you. Finally, I'm like paying attention to voicemail again. Once I have a good rapport with clients, a lot of times they're texting me, though it's really important for us to keep sort of the confidential information on email because that's where it's most secure. So I would say email is the best. A lot of times people reach out on LinkedIn. I think now the way LinkedIn is sort of like all over the place, it's hard for me to keep track, but
Oh yeah.
definitely. So I'd say definitely email number one, and people can certainly call. But if I don't pick up, don't leave a voicemail.
And what's the website they should go to?
Sure. So I'm at Ballard Spar. So my email's my last name, Klayman, Klayman, and then my first name starts with a K. So Klayman K at ballardspar.com. Ballard Spar is always like a tough one to spell, but BALLARDSPAHR and then .com.
Awesome. Well, it was a pleasure having you on Philly Fortune Talks today, Kimberly.
Great talking to you.
Thanks for tuning in to Philly Fortune Talks with Jake Penny. Inspired to share your success story? Visit phillyfortunetalks.com/guest and let's inspire together.